Welcome to our quarterly bulletin. My name is Metula Sikakana and I'm a business development manager at Equilibrium Investment Management. Just some housekeeping. We are applied for continuous professional development or CPD points. It is important to please watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of September and receive your CPD points. Our operations team will email you your CPD certificates to you during October 2023. Please also feel free to ask any questions during the session. Our speakers will either answer live or get back to you after the event. You will also find more information about the speakers under the speaker tab on the top menu bar, or if you scroll down, you can also download the PDF presentation. Okay, let's kick off the session. The topic today is, are we really approaching a smooth landing? Let's try and define this and what it means for the South African economy. The term smooth landing refers to the efforts by the South African Reserve Bank to slow the economy and bring down inflation. And this is usually done by rising interest rate. Never forgetting, aside from the problems that we as a country in South Africa have to face, we also have issues outside South Africa that we in fact have to deal with. It's not all doom and gloomy on the local front. Though it already feels like a long year, the South African Reserve Bank finally has capped the inflation within its inflation targeting range of 3 to 6%. And it is the first MPC that we did not see an interest rate hike after 10 consecutive hikes. To avoid a bumpy recession, careful guidance is necessary to steer the economy down from a high inflation, something of which the central banks have been struggling with, and this requires a delicate navigation of economic conditions and often factors outside their purview. In theory, the move cools down demand and brings down prices, but the instrument is a blunt tool in most cases and have no guaranteed outcomes. But I'm talking too much and cutting into my colleague's presentation. If this is all very daunting for you, then this session and your DFM will help you to a safe landing. I'll now hand over to Flobela Yates, the head of Equilibrium Investment Management, who will give you a brief overview on Equilibrium and introduce the much anticipated Equilibrium Global Model Portfolio Range.
Welcome to our second episode of Equilibrium's Quarterly Bulletin, where we unpack some of the benefits of the partnership between you, the advisor, and us, the Discretionary Fund Manager, or DFM. The purpose of partnering with a DFM like Equilibrium is to ensure that there's alignment between your advice process and the investment portfolios that your clients invest in. Why is this important? Well, we know that the best way to get investors to their objectives is for them to stay invested through the cycle. That means not only when markets are performing, but even more importantly, when they're not. At Equilibrium, we've designed portfolios in consultation with our advisor partners, taking into account your different advice processes in order to ensure that the portfolios are aligned to these and can be used alone or together to meet our joint clients' investment objectives. Our investment management due diligence process takes into account both qualitative and quantitative factors, and we are responsible for the entire portfolio construction process: risk management, legal and investment compliance, rebalancing, and Regulation 28 checks, as well as ongoing management of these portfolios, allowing you to spend your time doing what you do best, giving your clients the best financial advice for their unique circumstances. Let's do a quick recap of our investment philosophy and process. We follow an outcome-based investment philosophy. This means that the portfolio benchmark is the actual outcome that we're trying to outperform. For example, for clients looking for real returns, the benchmark or outcome needs to be linked to CPI. A portfolio with a CPI plus 3 benchmark is designed to try and get clients to outperform inflation by 3%. This makes it a lot easier for advisors to ascertain which portfolio is most suitable for their clients, rather than using an arbitrary peer relative or index benchmark, which may or may not deliver real returns. Very simplistically, this process has three main elements. The first allows us to define the most appropriate investment time horizon to get us to a particular outcome. Then we determine the acceptable level of risk required to get us to that outcome. For more conservative portfolios, we'd put more emphasis on downside protection and therefore invest in less risky asset classes, whilst for more aggressive portfolios with a longer time horizon, we have the capacity to include riskier as well as more offshore assets because we have the luxury of time to make up any big market drawdowns. And the final and third element is deciding on the actual benchmark. This is done in a scientific approach, looking at the expected returns from various asset classes, as well as the probability of being able to achieve these returns. When it comes to constructing portfolios, we also follow a three-step process. The first is what we call strategic asset allocation. This is the most important step in our process, as all our research shows that being in the correct asset classes gives you the highest probability of getting to a specified outcome. During the strategic asset allocation or SAA process, we ensure that we have enough exposure to certain asset classes, such as cash, income, property, and equities, and we run models to ascertain which asset classes we need in a particular portfolio. The second step then allows us to increase the probability of getting to a particular outcome by ensuring that within each asset class, we have sufficient exposure to the styles that drive better returns in that particular asset class. For example, within local equities, we look for value, quality, and earnings momentum. And then the third and final step is where we select and appoint managers and mandates to execute on those required strategies. It's a scientific process that isn't the same as split funding equally between 2 or 3 different managers, but requires skill and understanding what the appropriate exposure to each underlying mandate is. And it also takes into consideration the overall exposure at portfolio level. The partnership with Equilibrium is designed specifically to align with the advice processes, which consider actual investor outcomes and not some arbitrary benchmark, as I mentioned earlier. Being part of a large company gives us access to 177 investment professionals locally and 43 more offshore. But the core team managing your assets are these 12 incredible people. The diverse skills in our team include actuaries, CFA charter holders, certified financial planners, accountants, and people with various business and science degrees. With over 110 years of combined industry experience, this makes them the most qualified team to manage your local portfolios. Similarly, the team managing your offshore portfolios is equally qualified in the international space with over 180 years of experience. And since they are based in London, they have access to world-class portfolio managers around the globe. This team was created in 1998 and manages assets in excess of $8.3 billion. You are probably fairly familiar with our local portfolios, but let's have a quick overview of these. The core range consists of multi-asset solutions ranging from conservative to moderate and aggressive portfolios, but they also extend to income, Sharia, and equity portfolios. Each portfolio has been uniquely designed for a specific investment outcome or benchmark over the relevant time horizon. But in addition to this, the risk budget is allocated to ensure that we manage the risk to avoid a specific drawdown over shorter time horizons. Today, I'm delighted to introduce our global range, which you may or may not be familiar with. The offshore portfolios are constructed utilizing the same process as the local portfolios. It starts with strategic asset allocation, then looks for specific investment styles in each asset class, and identifies the best mandates or funds to execute on these. Our investment process is designed to make your job as an advisor as stress-free as possible, so that you can spend time with your clients and building up your practice. The Regulation 28 changes that were introduced last year allow investors to now invest up to 45% of their portfolio outside of South Africa. But there are many investors who want to take more of their discretionary assets offshore. Our 3 global model portfolios allow you to do exactly that, either through hard currency that is already offshore or utilizing the platform's asset swap capacity. Equilibrium's Global Cautious Model portfolio is designed for conservative investors. The Global Managed portfolio for investors with a moderate risk appetite, and the Global Growth portfolios for investors that are willing to take on more risk, allowing advisors to select the most appropriate option for each of their clients. The portfolios are designed using our outcome-based investment philosophy and use the same 3-step considerations: investment outcomes, time horizon, and acceptable level of risk. Because these are offshore portfolios, the outcomes are obviously not South African inflation. Instead, they aim to outperform a basket of currencies made up of a combination of British pound, American dollar, the euro, and Japanese yen. But I'll leave it up to our offshore team to take you through these in a little bit more detail later on. I'd like to take the opportunity to thank you for your ongoing support. We value our partnership with each of you, and we couldn't run what we do without each of you.
Thanks, Flo, for setting up the scene. Next is our economist, Sanisha Packirisamy, who will delve into why we can be optimistic that there is sufficient time for us to turn the South African economy around. Thank you for joining us today, Sanisha. Please take it away.
Hello, everyone. Back in 1967, James Meade, a renowned Nobel Prize laureate in economics, made a well-known prediction that painted a bleak future for Mauritius. He highlighted the nation's susceptibility to weather and price fluctuations, as well as its limited employment prospects beyond the sugar industry. But in a remarkable turn of events, this petite island nation defied all expectations, transcending its status as a struggling sugar-driven economy. Instead, it emerged as a shining example, boasting the second highest per capita income among African countries and earning the top rank in the World Bank's Doing Business survey for all sub-Saharan nations in 2020. Despite its vulnerability to external shocks as a small-scale economy, Mauritius has successfully charted a robust developmental path focused on sustained growth. The country's achievements can be attributed to a combination of factors, including political stability, a robust institutional framework, minimal corruption levels, and a favorable regulatory environment. Additionally, Mauritius' commitment to open trade policies has played a pivotal role in maintaining its economic momentum. Governed by a parliamentary democracy, the nation showcases an efficient administrative apparatus that demonstrates both technical expertise and adaptability in the face of ever-changing global economic conditions. Although there are no guarantees for its future prosperity, Mauritius has demonstrated its capacity to navigate various economic shocks successfully. Throughout its history, the nation has showcased adaptability, innovation, and a keen ability to anticipate global shifts. The amalgamation of effective leadership, consensus building, prudent macroeconomic management, and strategic policies for the private sector positions Mauritius favorably for the times ahead. Is it possible for South Africa to achieve the same transformation as Mauritius? I believe the answer is definitely yes. However, this outcome hinges on a proactive stance of our authorities, who must not remain passive spectators and should rather swiftly initiate the right strategies to grasp these so-called low-hanging fruits that lie within reach. The phrase low-hanging fruits is used to refer to quick wins that are easy to implement, in this case by government. It is knowing how best to use available resources and implement interventions that are most feasible, technically, politically, and administratively. These are actions that will likely have the greatest positive impact on growth and employment. The country has been overwhelmed with bad news over the past few months, and the mood of the country has remained sour. Business confidence and consumer sentiment are tracking nearly 15 and 20 points respectively below their long-term averages. In its Article 4 mission to South Africa, the International Monetary Fund remarked that South Africa's economic and social challenges are mounting, risking stagnation amid an unprecedented energy crisis, increasingly binding infrastructure constraints, logistic bottlenecks, a less favorable external environment, and climate shocks. The IMF noted that employment remains below pre-pandemic levels. Notably, unemployment is close to record highs on the back of already elevated poverty and inequality. In addition, the economy remains exposed to external shocks and capital flow volatility in the context of tighter global financial conditions and volatile commodity prices related to Russia's war in Ukraine. The IMF further highlighted long-standing rigidities in South Africa's product and labor markets, while warning that governance and corruption vulnerabilities have weighed on growth and employment prospects, ultimately threatening the future of social cohesion. Expressing optimism about South Africa against this bleak background might seem out of place, given flat growth in per capita incomes since the global financial crisis of 2008, job insecurity, malfunctioning state-owned enterprises, and widespread corruption. The Economic Reconstruction and Recovery Plan has been a key tenet of President Cyril Ramaphosa's agenda since he succeeded Jacob Zuma as the country's leader in 2018. But deep divisions within the ruling party and his own cabinet have hindered progress, resulting in a slow-paced implementation of political and economic reforms. The economy was already in a fragile state when it got hit by events like the COVID-19 pandemic and the Russian incursion of Ukraine. On top of that, sluggish investment prolonged economic stagnation. There were also domestic factors like restrictive macroeconomic policies and budget cuts that have contributed to sluggish economic activity. To make matters worse, global supply chain disruptions caused prices of food and energy to skyrocket worldwide, including South Africa. This made the cost of living crisis even more challenging for many households. The bottom 30% of spenders in South Africa have experienced an average inflation rate of 10% in the past 6 months. And as if that wasn't enough, the subsequent tightening of monetary policy added an extra pinch to struggling consumers. South Africa's reputational damage also took a hit earlier in the year when the Financial Action Task Force greylisted the country in February. A souring of international relations following allegations that South Africa had supplied Russia with ammunition via a Russian ship that docked in the Cape have further threatened South Africa's economic and political ties with the Western economies. As such, very few are doubting that this will be a very difficult year. But what makes me more optimistic on economic activity in the medium term is tangible progress on priority reforms which have been identified for their potential impact on economic growth and job creation. To fast-track the delivery of economic reforms which are at the core of the Economic Reconstruction and Recovery Plan, including those that have been delayed or blocked before, a joint initiative between the Presidency and National Treasury was set up to monitor progress and actively support the implementation of these reforms. This is done primarily through addressing obstacles that hinder execution on policy commitments. Government has noted that Operation Vulindlela differs from previous efforts in that it has provided a dedicated team with skills and capacity to mobilize technical support to get these reforms over the line, but using a hands-on approach. While Operation Vulindlela is not a new plan, it aims to ensure the effective implementation of plans that already exist without additional fiscal funding by removing policy and regulatory barriers to private investment. Since the launch of Operation Vulindlela in October 2020, government has taken significant steps towards implementing structural reforms aimed at stabilizing South Africa's energy supply, establishing a competitive logistics network, reducing costs, and enhancing the quality of digital communications. Other areas included as well reforming the visa system to attract the necessary skills for business growth, as well as providing a seamless experience for visiting tourists. This narrow list of focused priorities have been identified as the main economic levers to achieve the greatest positive impact on growth and employment. These reforms are meant to reduce the cost of doing business and lower the cost of living for ordinary citizens, which will make South Africa more globally competitive and increase the rate of inward investment. Let us take a look at each of these priority areas. Electricity reforms. In the electricity sector, the desired outcome of the reforms is to stabilize electricity supply. Reforms under Operation Vulindlela have been aimed at addressing the shortfall in electricity, the lack of competition in electricity generation, the inability of government to fund investment in additional generation capacity, and to arrest the deteriorating quality of municipal electricity distribution services. Reforms are currently underway to restructure Eskom by unbundling the utility into generation, transmission, and distribution. This, together with the Electricity Regulation Amendment Bill, which was approved by Cabinet in March this year, will allow for greater competition in electricity generation by increasing the role of independent power producers in the private sector. Not only does this instill a more level playing field for all power generations to operate on, these reforms will also achieve greater energy security. Moreover, the amendment to Schedule 2 of the Electricity Regulation Act to remove the licensing requirement for generation projects of any size has unleashed more than 100 projects or 10,000 megawatts, which are now at various stages of development. This accounts for more than 200 billion of private sector investment. In addressing Eskom's financial woes, the 2023 budget introduced 254 billion in debt relief to Eskom, subject to strict conditions. This financing will relieve pressure on the utility's balance sheet, enabling it to conduct the necessary maintenance. Finally, to establish and ensure a more reliable distribution of electricity by municipalities, regulations have also been amended to allow municipalities to procure power independently. Secondly, freight logistics. The subpar performance of South Africa's logistics system has resulted in the loss of significant export revenues for the country. Operation Vulindlela seeks to enhance the efficiency and competitiveness of freight transport. The Project Office, operating under the Presidency, has provided an update stating that Transnet Freight Rail has successfully completed the accounting separation between their operations and rail infrastructure units. This milestone is critical as it paves the way for functional separation and the establishment of an independent infrastructure manager, hopefully by the fourth quarter of this year. Such measures will facilitate transparent and accurate pricing of slots on the freight rail network, promoting fair competition between public and private rail operators. Transnet is also making strategic moves to address its deteriorating operational performance by promoting private participation in 2 of South Africa's container ports. Thirdly, water reforms. Reforms in the water industry aim to increase investment in the maintenance and construction of water infrastructure, as well as to improve water quality. Via the successful reinstatement of the Blue Drop, Green Drop, and No Drop water quality monitoring systems, government will ensure that water sources are protected, wastewater treatment plants are functioning, and leaks are fixed. Moreover, the project team has been successful in reducing the backlog of water use license applications. This improves the ease of doing business in South Africa. More than 70% of applications are now being processed within 90 days. Operation Vulindlela is also currently engaged with revisions to the raw water pricing strategy. This should address suboptimal pricing and the financing of water. It should also pave the way for more investment in the agriculture and mining industries in particular, as more certainty around these outcomes are created. Fourth, digital communications. Reforms in the digital communications sector will reduce the cost of data, expand internet access to low-income households in outlying areas, drive new investment in telecommunications infrastructure, and unlock gains in the knowledge economy. Spectrum frequency is a finite resource and must be allocated efficiently to increase network speeds and reduce costs. The auction of high-demand spectrum, completed in March last year, is expected to facilitate these gains. The switch-off from analog to digital transmission is required for the conclusion of the spectrum auction process for the use of other network operators. However, Operation Vulindlela has reported that a majority of provinces have already completed this migration. Fifth, reforms to the visa regime. Lastly, there was a need to improve the regulatory framework to create a more conducive environment for attracting skills and enabling companies to invest in South Africa and supply the skills that the economy requires. Under the guidance of the Project Office in the Presidency, a revised critical skills list has been published to address the change in skills requirements. Moreover, reforms to the visa regime were needed to promote tourism, which is a large driver of employment, particularly for small businesses in South Africa. The successful implementation of the e-visa system now serves 34 countries and should facilitate growth in the tourism sector. Tourism is a quick and easy way to create jobs for relatively unskilled persons. Growing this industry can establish a strong multiplier effect on the economy. Meanwhile, further work is being explored to expand visa waivers and establish a points-based system to introduce greater flexibility into the visa process. These concrete reform efforts are firmly underway, in spite of an uncertain political future. Support for the ruling party has waned in light of economic deterioration and perceived widespread corruption. Policy confusion and political uncertainty have prevented South Africa's business community from expanding, hiring, and investing. At the start of this year, more than 90% of manufacturers, the highest on record, stated the political climate was the key reason deterring additional investment in the local economy. Moreover, the private sector is reluctant to partner with the state, given a widening of the trust deficit in relation to government's financial and operational maladministration, particularly evident at our state-owned entities. That said, there has been an easing of investor anxiety towards South Africa in some areas where radical economic transformation proposals have been vastly watered down, namely expropriation without compensation, the nationalization of the Reserve Bank, and prescribed assets. Nevertheless, government could still do itself a favor by spelling out its goals more clearly to further reduce policy uncertainty and to reignite confidence in the long-term sustainability of South Africa as an investment destination. In conclusion, while long-term investment to the development of any nation revolves around building productive capacity and developing its human capital through enhanced outcomes in the health and educational space, shorter-term measures by government are necessary. The so-called low-hanging fruit or quick wins we have outlined, in addition to arresting increasing lawlessness and encouraging accountability, are vital in stimulating private sector activity. In turn, this has the potential to ease socioeconomic pressures and reduce joblessness, inequality, and poverty through an increase in employment, boosting living standards, and advancing social inclusion. South Africa faces a grave challenge in fostering an economic recovery in difficult global and local conditions. The latter, which has been marred by a disintegration of a shared and coherent political, social, and economic vision for the country. This is not the time for complacency. If authorities act quickly to promote these low-hanging opportunities by creating an enabling environment for more private sector participation, increasing competitiveness in the country's product and labor markets, restoring the integrity of South Africa's democratic institutions, and reducing corruption, we could get the economy going again. Let's not forget that South Africa has enormous potential, supported by its diversified economic structure, an abundance of natural resources, deep capital markets, a first world financial system, strong institutions such as the Reserve Bank and an independent judiciary, and free media. Even though some of government's functions are failing to provide adequate infrastructure and services on which the economy depends, South Africa is not a failed state. Significant inroads continue to be made by government, business, and civil society. There are increasingly more examples of role players outside of government that are plugging the holes left behind by the state. This augurs well for a better future for our country. In our view, the scope for the private sector will increasingly widen, whether the incumbent government allows for it or not. Moreover, recent initiatives to improve governance and strengthen public institutions, coupled with tangible progress in key areas of structural reform under the direction of Operation Vulindlela, are indeed steps in the right direction. While these efforts need to be complemented by fiscal policies that stabilize debt and need to be backed by re-established business confidence, there is enough progress to suggest that South Africa may yet spring a positive surprise to steer this economic ship in a different direction. Thank you for your time.
Thanks for sharing such great insights, Sanisha. Next up, we've got Thami Khoza, our portfolio manager here at Equilibrium Investment Management, who will discuss how our local models are weathering through tumultuous times. Pleasure to have you join us today, Thami.
Thanks, Matula, and good day, everyone. Today, I'll be reporting back on our local models. If you haven't yet done so, please download today's presentation and the quarterly report document by clicking on the Downloads tab at the top of the event platform. We start off with an overview of asset class returns. This is important as it provides context on how our portfolios have performed, as well as the underlying funds. We will, of course, get to this later on during our discussion. From a currency perspective, the USD ZAR depreciated over the last quarter and during the 12-month period ended 30 June. Over the last quarter, the depreciation in the rand was primarily driven by fears over the infamous Lady Russiagate. However, we did see the rand start to come in during the month of June due to receding fears of the Russia debacle, less severe load shedding, and a slight optimism on local inflation falling within the 3 to 6% target band. Interestingly, the weakening in the rand over the last year was more so dollar strength due to higher interest rates in the US. You will recall that a weakening in the rand is positive for global portfolios, as it means that foreign currencies are converted at a higher rate. Moving on to global asset class returns. Global equity was relatively flat and returns were primarily driven by tech stocks, which were extremely sold off for the greater part of 2022. Global property returns were also muted and the performance was mainly driven by a weaker rand. If we turn our eye onto global bonds, the returns were characterized by headwinds from a potential debt overburden in the US, and lastly, from a global cash perspective, global cash returned attractive returns, mainly due to higher cash yields and, of course, benefits from the currency. Focusing on local asset classes, SA equities was hard hit by the resource sector, which came under pressure. This was due to fears of a slowing Chinese economy. However, strong performance from the financial and industrial sectors slightly mitigated these headwinds. SA property was flat. You will recall that we execute on property using a flexible property mandate that allows us to tilt between local and global property as and when we deem fit. South African bonds came under pressure, mainly due to the Russia weapons saga, which I mentioned earlier. However, post-quarter end, we did see bonds starting to come in, which resulted in improved performance from this asset class. Lastly, SA cash remains on a positive trajectory, and this is in light of the short-term interest rates, which are currently high. Looking at a snapshot of investment returns within our standard portfolios, you can see that the portfolios are ahead of their respective benchmarks over the 1 and 3 year time horizon. The portfolios are slightly behind their benchmarks over their respective time horizons for the other portfolios. However, what remains quite encouraging is that the portfolios are all ahead of their peers. And although we don't manage the portfolios in relation to the peer group, this is a very good and important sense check. So you might ask, what were the key drivers of performance in our portfolios? This attribution table indicates that performance was primarily driven by our strategic asset allocation. While the results from our tactical asset allocation as well as investment manager selection were mixed, we'll of course delve a bit deeper into this. You can see from this slide that global equity was a large contributor to our performance within the portfolios. And this we had discussed at the beginning of the presentation in terms of how this asset class has performed. Another noteworthy contributor to performance was South African equities, which you can see is the purple line on this particular slide. Tactical asset allocation actually speaks to how we underweight or overweight, as well as take neutral positions within various asset classes, depending on our short to medium term views. As you can see, the results were mixed from a tactical asset allocations. There was a positive TAA contribution in the stable, moderate, and unconstrained portfolios, while TAA detracted in the conservative, balanced, and growth portfolios. Let's see how investment manager selection has fared. Momentum enhanced yield contributed positively to performance due to a high allocation to floating rate notes in the market where short-term interest rates remain high. For its underweight position to consumer discretionary and precious metal sectors contributed positively to performance as these sectors were hard hit by the various market conditions over the quarter. Visio's conservative bond positioning boasted well for the fund, given the sell-off that we saw in the bond markets during Q2. If we turn our eye to the detractors, Momentum Core Equity, which is our smart beta capability, underperformed, mainly due to underperformance from the three sleeves. You'll recall that they are value, quality, and momentum. The underperformance in Momentum SA Flex was mainly due to a high allocation to longer dated as well as ultra longer dated bonds. Given the sell-off in the bond markets, these bonds were extremely impacted by duration. The underperformance from core shares was driven by a timing difference from when the benchmark is valued and when the fund is valued. We of course expect these to reverse over time. As we continue with the other portfolios, you will see that one manager that we've now included in this slide is Fairtree. This manager has performed quite well, and this is mainly due to underweight positions in the consumer discretionary and property sectors. This has of course contributed positively to performance. However, this was slightly offset by a position in precious metals. As I mentioned earlier, we do make tactical asset allocation calls based on what our short and medium-term asset class views are. You can see on this slide that we haven't made changes from the first to the second quarter of the year, and I'll briefly discuss why. Locally, we remain overweight South African bonds. This is because bond yields are quite attractive and they offer a more certain probability of achieving those returns. Although the macroeconomic backdrop is not favorable in South Africa, South African property and South African equities do display attractive valuations, and we therefore have retained a neutral as well as neutral to overweight position respectively. Globally, cash is showing attractive yields, while bonds are pricing in a recession. We've therefore maintained neutral positions to these asset classes respectively. Global equity remains a valuation story, and despite some market participants anticipating a very strong recovery, there are still some fears of a global recession that remain looming. We therefore retain an underweight to neutral position in global equity. We are neutral on global property, although we note that the opportunity set from a global perspective is quite diverse in comparison to local property. We'd like to then conclude with the last two slides, which talk to our portfolio changes in relation to global and local property execution. We currently execute on both asset classes using Catalyst's Flexible Property Fund. The benefit of this execution is to give the manager greater flexibility to add value, not just from a share selection perspective, but also to tactically tilt the portfolio between local property, local cash, and global property. The composite benchmark to which the manager manages this fund was 75% local property and 25% global property. Your clients would have recently received a ballot form from Sanlam Collective Investment Schemes indicating Catalyst's intention to change the composite benchmark to 60% local property and 40% global property. This gives the manager greater opportunities to add value, and we fully support this change given the concentration within the South African property sector. We, however, needed to ensure that we were not structurally underweight either of these two asset classes and needed to use completion strategies to compensate for this. The change in our execution of property was to allow for this to happen, and is shown in the graph where we will amend the allocation to Catalyst Flexible Property accordingly, and we will complete with Sesfigile Property Fund while selling out of the Catalyst Global Real Estate Feeder Fund. Lastly, you might wonder what is the impact on fees. As you can see from the slide, that the impact on fees is quite negligible. And that concludes our discussion for today. Thank you very much for your time, and I look forward to any questions that you may have.
Thank you very much, Thami. And now I will hand over to Richard Stutley and Jade Koch from our London office, who will introduce the Equilibrium Global Models. Welcome, Richard and Jade.
Good afternoon from London. Jade and I are delighted to take you through the global multi-asset models that now form part of Equilibrium's model portfolio offering. The global model portfolios are designed to take the guesswork out of navigating the offshore landscape, removing the burden of selecting the optimal asset allocation and fund manager mix. Instead, we do it for you. At the same time, the models still provide you with access to the full range of investment opportunities globally. We're not just buying things in one country, on one stock exchange, or from one fund management house. We look everywhere. Okay, jumping straight in terms of philosophy, here are some of our key beliefs which define the way in which we invest. Number one, markets are inefficient. And at times, bonds are too expensive. At times, equities or a particular region within the global equity market is too expensive. At times, gold may be cheap. And this means it's worthwhile overweighting and underweighting asset classes in a risk-controlled manner. And that's what that first rectangle means. Secondly, we want to look as widely as possible for investments. If, for example, no one's looking at Chinese real estate companies, then we're likely to be able to buy them at below fair value. And that's what makes a good investment. Next, valuation is key because this time is rarely different. That's the third rectangle. Number four, no single manager or investment house is good at everything. So we're not going to invest exclusively with one manager. Instead, we want a specialist for technology stocks, a specialist for mining stocks, a specialist for EM currencies, and so on. And finally, there are multiple sources of performance. We expect to get performance out of our asset class decisions, out of our balanced investment styles, and to benefit from selecting the best managers from around the world. Now, here are the models again. Equilibrium Global Cautious is our lowest risk model with strategic weights of 62% in fixed income, 30% in equities, and the remainder in a mixture of commodities, real assets, and cash. As it's the lowest risk model, its return target is also lower at cash plus 2.5%, and it has the shortest recommended time horizon. The managed model is more risky with 60% in equities and 33% in fixed income. As a result, it has a higher return target, now cash plus 4%, and a longer time horizon of 5 years. Finally, our most aggressive model is Equilibrium Global Growth, which has 90% in equities and the remainder in fixed income and real assets. The return target is cash plus 5.5% per annum with a long-term investment horizon of 7 years. Our starting point when building portfolios is to have a smart strategic asset allocation. When people say a cautious portfolio should have 70% in bonds and 30% in equities, they've pulled those numbers out of a hat. Instead, when you look at this slide, you're looking at the science. This is backed up by academia and by very extensive modelling we do in-house. And what that tells you is actually a cautious portfolio should also have things like gold and inflation-linked bonds, and a growth portfolio should have some things like real assets alongside equities. On this slide, you can see that over time, this process has delivered on its performance objectives, and hence all of the models are ahead of their targets. Now that was returns in dollars. You know, of course, what's happened to the rand over time, and hence returns in ZAR have been significantly higher. And this highlights again that investing in global markets is not only about taking advantage of that big opportunity set, but also hedging portfolios against the rand. We're focused on outcomes being what ultimately allows your clients to achieve their spending goals, but the portfolios are not immune to what happens in markets. Now, as you know, and this can be seen clearly in the dark red column in these tables, 2022 was an exceptionally tough year given the sharp rise in policy rates and bond yields, leading to poor returns for pretty much all global asset classes. The equilibrium models weren't immune, but thanks to their broad-based diversification, we managed to protect capital against pretty much all major asset classes. Year to date, thankfully, we've seen a decent rebound, and hence the tables turned green again. And this really highlights why you should stay invested and avoid capitulating at those lows. During the second quarter, we've seen inflation easing. The Fed's paused rate hikes. The banking sector has stabilized. As a result, global equities were up over the quarter. Bonds, on the other hand, continued to reprice and were therefore down by 1.4%, as you saw in the previous slide. Now, despite that negative return from global bonds, all three model portfolios delivered positive returns thanks to our underweight to duration. They also all outperformed their cash plus targets as well as peers, which is clearly what we're looking to achieve. Cautious outperformed peers over all time periods from 3 months to 7 years. It's slightly behind its cash plus target over 3, 5 and 7 years, but the margins therein of between 0.1 and 0.2% are not particularly large, and also that's taking into account last year's sell-off. Managed then's ahead of peers over all time periods as well. It's in line or ahead of its cash plus target over all periods except 5 years, where the margin of underperformance is 0.5%. And finally, growth, again ahead of peers over all time periods, up 13.4% over 12 months and largely ahead of its target. Now, these numbers are particularly decent, I would say, when you think about the period we've been through. It's been one that's been characterized by equity outperformance. Equities have dominated all other asset classes, some 8% per annum ahead of property, for example, some 5% per annum ahead of high yield. So diversification hasn't worked in this most recent period, and of course we would expect it to as markets revert to more normal conditions. Here's performance of the underlying managers, and again there's no real concerns here. Our developed market equity blend, shown as one line at the top there, but remember there are 11 underlying managers in that blend. It returned 5.3% during the quarter, slightly behind the MSCI World Index, and this was the biggest headwind to returns last quarter, that underperformance. Jay's going to touch on this topic in more detail in just a moment, but suffice to say we're not intending to change our diversified approach to investing in equities on the back of one quarter's return. Dodge & Cox and Coronation Global Strategic Income have both performed well thanks to their corporate bond allocations. Standard's return of negative 0.5% is not bad as well in the context of global government bonds, which were down minus 1.9% in the quarter, as shown in the line below. There has been a change at Standard, you may know, with the appointment of a new sub-advisor, JP Morgan. We know the portfolio manager well, and hence we're happy to hold on to our investment while we complete a full review of the new strategy. Dodge & Cox's broad remit allows them to invest in emerging market debt and to take advantage of the dollar weakness we've seen recently, which I have a slide on later. The key detractor over the quarter then was gold. You can see that, managed by 91. We continue to like it as a diversifier. While inflation is clearly on the right path, down, there's not an insignificant risk of further bounce in inflation down the line when one thinks about the combined forces of things like aging populations, decarbonisation, robotics and automation. With that, I'm going to hand over to Jade for some more details on current market dynamics.
Thanks, Richard. Hi, everyone. Thanks for having us on today. Let's dive straight into some of the key themes that we're seeing in markets at the moment. Focusing firstly on equities, the asset class has delivered positive returns year to date across the style spectrum. And as you can see on this slide, it's the growth and quality styles that have led the way, with value lagging behind. However, when we look under the bonnet, it's a narrow subset of growth stocks that have driven this strong positive performance. The Magnificent Seven, as these stocks have come to be known, are all US mega cap companies that have benefited from the recent hype around artificial intelligence. In aggregate, these stocks were up 65% during the first half of the year, whilst the remaining 493 stocks which make up the S&P 500 index generated around 10% of positive performance in aggregate. So although it appears that growth has been the winning style year to date, this was predominantly driven by just 7 stocks. It's also worth highlighting that due to the size and performance of these companies, they now comprise almost 30% of the S&P 500 index. Therefore, it's been difficult for active US and global equity managers to take an overweight or even neutral position in these companies relative to the index without taking on too much risk in their portfolios, given that these companies are all US mega cap and sit within just 2 sectors. This demonstrates why it has been difficult for the active global and US managers to outperform the index year to date. You can see on this next slide that these stocks sit within just 2 sectors, technology and consumer discretionary, which are up around 30 and 40% respectively year to date. Although these are impressive returns, we recommend maintaining a good balance between styles and geographies in portfolios for various reasons. Firstly, it can be risky to have too much exposure to such a small group of stocks that are trading on rich valuations. If something were to change, perhaps these don't turn out to be the winners in the artificial intelligence race, or new regulation comes in, then these companies' share prices could fall significantly. Also, as long-term investors, we believe that a balanced portfolio will outperform over the long term, even if a particular style or theme does well in the short term. Finally, diversification is important when we're thinking about risk in a balanced portfolio. With this in mind, I wanted to touch on our developed market equity implementation via the Momentum Global Equity Fund, which is held as part of the developed market equities allocation across all of our model portfolios. This is a multi-manager solution which blends best-in-class funds, offering a balanced portfolio across styles and market caps at a low cost. As you can see, diversification is a key characteristic in this portfolio, with a quality value manager in Australia, a growth manager based in the US, and a multi-factor manager based in Europe, for example. Turning our attention to valuations within the equity space, we still think that US equities look expensive relative to other regions such as the UK and Japan. Also, despite the fall in valuations from peak levels in 2021, the valuation spread between the US, as depicted by the black line at the top of this graph, and other regions has in fact widened. We are also conscious that a global recession could be looming, and although we do not know how deep this recession will be, this poses a potential risk to companies' earnings. For these reasons, we are underweight equities in portfolios. From a bond perspective, sharp rises in interest rates and bond yields are generating some of the best opportunities in safe haven government bond markets that we've seen in many years. Looking at this chart, you can see where we used to be in terms of bond yields relative to the dividend yield on equities and where we are now, and bonds are looking much more attractive. However, whilst we like bonds much more now than we did in the past, we're still a bit underweight versus our strategic asset allocation, and that's because there's still a bit of disconnect between the market expectations and the Fed's target. On this graph, you can see that mispricing. The Fed thinks future interest rates are going to look like the red line, and the market thinks they are going to look like the yellow line. We're more inclined towards the Fed's view, which you could summarize as higher for longer. And hence we think it's better to wait for a better time to add to your bond holdings. The last asset class that I wanted to speak about is alternatives. Alternative assets such as property, private equity and infrastructure have suffered over the past 2 years, and these portfolios are now trading on significant discounts to their net asset values. Although we likely have not reached the peak of the policy tightening cycle, we are certainly a long way through, and we believe that the headwinds facing these diversifying asset classes, which in some cases offer protection against inflation risks, will begin to ease. All in all, the valuation opportunity for these assets is increasingly compelling. Finally, filtering all of this down, we get to our tactical asset allocation views, as demonstrated on this slide. We rate each asset class on a scale from 1 to 7, with 1 representing a strong negative view, a 7 representing a strong positive view, and a 4 a neutral view, relative to our strategic asset allocation. Richard is going to talk about this in more detail later in the presentation, but overall we have a neutral view on fixed income, we're positive on alternatives, and the only change that we made recently was to slightly underweight our equities allocation, and this is predominantly a reflection of our view on US equities, which is a large component of the developed market portfolios. Thank you so much for listening. I'll now pass you back to Richard for a final summary.
Thanks, Jade. In this slide then, we're picking up some dollar weakness against the majors, most importantly the euro and sterling. Since October, the dollar is down by around 12% on a trade-weighted basis to the end of June this year. As it says there on the slide, the dollar could continue to weaken in the short term, but I have to say we don't subscribe to the view that an alternative to the dollar's use in international trade is likely to gain traction in the near term. In short, therefore, we retain a decent allocation to that dollar. In terms of our overall positioning, on the left-hand side, you can see we like equities, but they've moved a long way in a short period of time this year, so we're slightly underweight with a bias to EM over DM and in particular the US. As always, we remain style blended to ensure we don't miss out on any surges in particular industries. Then on the right-hand side, we like alternative income sources like property, as well as diversifiers in the form of gold and precious metals companies. And finally, in the middle, we like bonds a lot more than we did, but we're still a bit underweight versus our normal allocations, and that's because of that mispricing in interest rate expectations, which Jade described. Here is that positioning in detail. I'd point out you can see all the models are running some extra cash as shown in the table towards the top right-hand corner. Okay, finally, some last thoughts from me. Headline inflation has peaked and is now falling sharply, we know that. Nonetheless, we expect monetary policy to stay tighter for longer than the market is currently discounting. The all-important US economy continues to perform well, but in terms of risks, monetary policy works with a lag, and it's still very early in terms of seeing the full effects of the very significant rise in interest rates that has taken place over the past 12 months. Next, we shouldn't ignore the risks of a recession, and hence we're marginally underweight equities, which are discounting overly optimistic earnings growth assumptions in our view. We've seen a recovery in markets and the equilibrium models. Last quarter, our returns were a little pedestrian compared to MSCI World, but we expect the factors driving this, most importantly the dominance of mega cap tech stocks, to fade in time. Markets have already moved a long way this year, so caution is necessary shorter term, but we're in a completely different and thankfully much better place compared to the last few years, with meaningful yields on offer across the investment spectrum. Hence, return prospects from here look good for the medium term. Many thanks again for your time, and do get in touch if you have any questions.
Thank you, Richard and Jade. Just a reminder to please watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until end of September and receive your CPD points. Thank you very much for joining us today. We hope you find this webinar insightful.